Hey traders, this is Blake Morrow with Trader Summit, and it's Friday. And when it's Friday, you get the one and only Jim Welsh from Macro Tides. He's joining us today. And Jim, you're going to be talking to us about this massive rally that we're seeing in the equity markets as we
Yep.
inch closer to an election. And the dollar got slapped was really strong this week, is reversed. Stocks remain strong, and gold's at all-time highs. So tell us
Yep.
what's changed this week in your view. Anything change?
Not too much. No, I mean, again, we continue to get data that's constructive and positive. The retail sales number came out. It was better than expected. We're going to talk about that in a bit, but in other words, it was a really good number. But when you look underneath the surface again, it's like, okay, not quite as good. But overall, the data continues to come in all right, which means the market has been dialing back. A few weeks ago, it's like, oh, the Fed's going to be cutting at least another 50 in the next two meetings. Now they're back to, well, maybe two quarter point moves. And I think that's why the dollar has benefited. And I think just events in the Middle East and so forth, and just the lack of selling pressure for gold has been very constructive there. And Treasury yields have ticked higher, but I think we're getting close to a top in Treasury yields. So really, it's just been a continuation, I think, Blake, as far as data coming in a constructive way. The economy looks okay. The election is a wild card. The betting markets seem to be thinking that Trump is gaining ground, and some markets are moving because of that. But I think it seems to me like it's too close to call in terms of the election.
Yeah, I mean, you would think it's too close, but you're right. The betting markets are favoring Trump, and then as you pointed out, there's a lot of markets that I tend to focus on, like the crypto. Obviously, a Trump presidency is pro crypto, so Bitcoin's getting close to 70,000. It's looking like it's technically breaking out.
Yeah.
Dollar Mexican peso, the Mexican peso is getting weak because for obvious reasons. Whether it's the new government or that Trump's probably going to hold their feet to the fire, or the border wall, or immigration. There's going to be a lot of pressure on the peso. So you're seeing that little bubbling pop up. But do you think? And I'm going to ask you this question before we get in your charts. Let's just imagine. We fast forward to November 5th, November 6th. We have stocks that, I would assume there's a lot of people that just don't want to sell equities because they feel that at a Trump presidency, equities are going to be higher. So let me ask you this: your gut instinct. What happens with equities on a Trump win and on a Harris win? Just off the cuff, I know you probably want
Yeah,
to
yeah.
prepare for this a little bit better. Maybe give us some more evidence. In maybe the weeks ahead or next week or something.
Yeah,
But
yeah,
just
yeah.
off the cuff, what are you thinking?
Yeah. Well, I think, again, in terms of pecking order, I think the economy remaining on solid footing is the most important issue for the equity market. Number two is, yeah, the Fed maybe won't cut as aggressively as we thought, but they're still going to be cutting. And then number three is the election. Because whatever happens in the election, whatever policies are adopted or changed, that's not going to have an impact immediately on the economy. I think the markets are of the belief that, gee, last time when Trump won, I think the Dow was down 1,000 points overnight. And then, we saw a massive rally. So I think the mindset is that it'd be good for banks because of deal making, less government regulation, and so forth. So I think the mindset is that you get a bigger pop because of if Trump wins. I think there's the potential for a pop no matter who wins, just from the standpoint, it's one less thing we have to think about. You know, the point I would make is unless it's really a landslide, and so far it doesn't look like that's what's developing here, I don't think the election is going to be decided on November 6th. States like Pennsylvania, a very, very significant number of their votes are mail-in votes. Their state law doesn't allow them to start counting those votes, Blake, until election day. So and I think there's maybe one or two other states that have similar type laws. So the point being is some of these really decisive states, they may not really have the final tally. And what that opens it up to is a lot of those votes are city votes in like Georgia, Atlanta, major cities in Pennsylvania, which vote much more Democratic. So, like we saw last election between Trump and Biden, is that the numbers came in and made it look Trump-like was in pretty good shape. And then all of a sudden, these mail-in votes and so forth get caught up, and they're more predominantly Democratic voters. And I think there's another swing factor that can take place. So I don't think the election is going to be decided. And if it's a close election, I don't think either party will accept it.
Yeah. And then obviously, Congress is going to matter too, right? If it's a red sweep
Yeah.
or it's obviously.
And the Senate. So I'm not sure we're going to know all the answers on November 6th the way I think we would like to. But again, for me, my trepidation is I think whoever loses aren't going to accept it. I mean, and again, going back, everybody knows what Trump did, all right? And it was, I think, reprehensible. At the same time, when he won in 2016, Hillary Clinton, just about every major Democratic figure, said it was, an ill-gotten election. He really didn't win. He only won because of the Russians. It's an illegitimate presidency. So my point is, both parties have gone down that road. Trump went further down the road, obviously. And I just think that the dynamics are so terrible
Yeah.
that neither party will accept it. So I'm hoping that it's a clear-cut victory so that diminishes the traction those stories will have, but they're going to have X amount of traction with the followers that are, the faithful followers of either party.
That makes sense. All right. Well, Jim, thanks for providing that information. And I know we'll probably be talking about the election for the next few weeks as we go through these weekly conversations. And let's just also let me stop and mention this. If you like Jim's content and his opinions and his videos and his all the direction he gives you every week, make sure you give him a big thumbs up. Subscribe to this channel so you don't miss these exclusive talks that Jim and I have. And make sure you comment down below if there's something you'd like to add to this conversation. So Jim, let's go ahead and jump into the charts that you brought, and let's start with retail sales because, man, the U.S. consumer is not backing away.
Yeah, the retail sales are up 0.4%, which was a better than expected number. The annual increase, Blake, was 1.7%. And retail sales aren't adjusted for inflation. So in other words, if prices went up at the stores, that gets added into the net change for retail sales. We know where the CPI was 2.4% over the last year. So if you subtract, the impact of the CPI inflation, retail sales year over year actually would have been a negative number. All right. So my point is, I just feel like there's people overreacting a little bit to a headline and not really kind of digesting and thinking about it. Number two, this chart shows the seasonal adjustment for September going back a decade. And you can see it bounces around a lot. But the number for September of 2024 is the biggest seasonal adjustment that there has ever been. Relative to last year, it added about $13 billion above last year's number. In other words, last year's seasonal added $20 billion. This year's seasonal was about $33 billion. You look at that difference of $13 billion. Total retail sales was 714%. Well, what's 2% of 714? About $14 billion. So my point again here is I don't know what's going on with the seasonals. We talked about it last week in terms of the last employment report. The seasonals added 785,000 jobs to the home survey, household survey. And now we see this. So I don't know what's going on with the seasonals, but they're, amplifying whatever the number is to the positive. So again, trying to, accurately count all this stuff is not an easy task.
Yeah.
But when I see things like this, it just makes me, geez, what's going on here? because relative to the last decade, the number for this year in September was goose, it's like 40% more than the highest we've ever seen. That's pretty significant. So
That
anyway,
is. Okay.
overall, does it take away from it was a good number? It was a solid number. So I'm not trying to negate it, but it's like the enthusiasm was pretty over the top.
All right. Well, let's take a look at the next chart you brought, Jim, which is
Yeah.
U.S. government debt. And this is, I sit here and I look at these types of things, and it's like, that's a big
Big
left
jump.
to right, big jump. I mean,
3 weeks. Yeah.
yeah, like how do you buy the dollar? How do you buy US Treasuries when you see this type of, but anyway, it's
Yeah.
mind-boggling. Explain
Yeah.
why this chart's so important to you.
So the only point is the government ends its books September 30th. And the same thing happened last year. All of a sudden, October, there's this huge surge. So again, what's causing this big number? I mean, it doesn't happen in any other month or beginning of any other quarter. So in a sense, are they attempting to suppress spending in September so that the annual deficit doesn't look quite as bad? And then all of a sudden we blow through it in October. I don't know. At the same time, this kind of an increase in debt, gives the economy a jolt. It's spending, So again, I think we live in a very strange period of time, where government statistics. Somebody once called them lies, and government statistics or something. But again, look at the trajectory here. The deficit at the end of September as a percent of GDP for last year was 6.4%. Folks, that has never, ever, ever happened anything close to it when the economy wasn't in a recession, or we had a pandemic, or we were fighting World War II. So this is extraordinary what's happening. And both candidates aren't talking about spending, deficits, and so forth. It's not, well, Harris's program is less negative or less of a deficit builder than Trump's. Fine, but it's still going to be significant, and there's no curtailment. So
Right.
this is, to me, one of the important issues facing our country over the next 5, 10, 15 years is how are we going to handle this? And if things start to spin out of control, then you've got some very serious problems. And neither candidate, neither party is talking about it.
All right. Well, and I have a feeling they're going to continue to avoid it
Avoid it
through November 5th. So no
yeah.
one's going
We'll talk about dogs and cats in Ohio, but we're not going to talk about.
no one's going to hold that hot potato. Okay.
No.
So the first chart you brought for the markets that we watch is the juggernaut of gold. I can't argue that it's going anywhere but higher, Jim. Can you? I mean, I know
when we talked last week, 2-3 weeks ago, I thought we were set up for a correction that would take gold below 2,500. All right. Didn't happen. I mean, it pulled back less than 3%. You can see that blue trend line. It held right where it had to hold. The red and the green lines are the 5 and 13 exponentials. And that dip took place, but they never really crossed. So just from a basic trend following thing, the trend is still up. And the only thing that's showing up right now that's a little bit of a negative is gold is making a higher high. The bottom panel shows its RSI, and it's making a lower high so far. But if gold keeps motoring, the RSI can obviously get back to where it either confirms or gets comfortably above 70 to say, well, that's still some decent strength. So again, last week, my take was on Monday, I said, I think we're going to get a pop above 2,700 based on this technical setup. And, here we are.
Yeah. So wave 5 continues as wave 5.5.
Keep going. Yeah.
All right. The dollar. Now, this has been kind of staggering to a lot of people because just a few weeks ago, Jim, you marked a reversal, and we reversed pretty damn hard. And a lot of people are looking at this saying, I just saw, we were talking about this in our community. this
Yeah.
week, The Economist has the dollar on the front page, and usually that's not a good, that's an ominous sign
Yeah.
usually, but still, regardless, I mean, this has been one hell of a move. So what do you
Yeah.
see the dollar doing from here?
Well, let's just point out again that the dollar peaked at 114 and change in October of 22. So even with this big move, it's down 10 points, which is what? I don't know, 8 or 9% from that high.
Yeah, it's
Okay. So I've been looking at this pattern where, as the numbers show, 1, 2, 3, and I thought that from the low, where that number 3 is at 100.51, that the bounce to 101.92 was a wave A of 4, then the drop to lower lows was B, and we were going to get a rally to 102, 102.50 to do a 4. And the thing that when you look at pattern analysis, you look at the length, the amount of time various waves and movements last. So if you look at wave 2, it lasted 22 days. Well, wave 4 is at what, 52 days? So in Monday's report, I kind of said, you know what? This just doesn't look right. And therefore, that's why I put the 5 down there by the 100.16, because that kind of says, okay, from 106.52, where the green 2 is, we've had 1, 2, 3, 4, 5 to complete something. And this rally now is the retracement of that decline. The 618 retracement level was 104.09. We got obviously really relatively close. But you can see the 5-day moving average is comfortably above the 13-day. So what that, to me, Blake, suggests that there's likely to be some choppiness here. But I think the dollar's approaching another trading high, and the next bigger move is going to be to the downside. I think the dollar will decline below 100. I think there's the potential sometime in next year, we'll see the dollar below 95.
Wow, that's well, maybe it has something to do with the previous chart, Jim.
Yeah.
Maybe that decline has something to do with this. Oh, I'm just saying,
Yeah.
All right.
Yeah.
All right. Well,
I think it's more likely, Blake. I think, again, the economy has held up better than I thought. I thought we would see more slowing.
Yeah.
And one of the things I've pointed to is, hey, government spending at 6.4, running a deficit of almost $2 trillion. That's a huge support underneath the economy. Plus, the unemployment rate's low, wages are going up, and all those good things are still happening.
Jim, I got to ask you this question. Where's all this spending going? I mean,
government spending.
I didn't see anybody dropping money into my bank account. Where's it all going? Where's all this deficit spending going?
Well, obviously we're spending more militarily. I mean, we're supporting Iraq, or pardon me, Kuwait and Israel.
Yeah.
We're supporting, we've had a lot of people come into this country. Okay. Infrastructure building is part of it, and just the normal spending that the government does, mandatory spending. When you add up defense and all the social spending, Medicare, Social Security, the food stamp program, it's about 85% of the budget, Blake. So this is the crisis, is that there's no way we're going to be able to address the deficit without talking about some of the programs that are considered sacred.
Yeah.
So that's where all that money is going.
Okay. All right. Well, Jim, real quick, we let's jump back over into the charts. I appreciate your candidness about
Sidebar.
that. Yeah. We have the bond market and we have TLTs.
Yeah.
What does that do for bonds? I mean, like, do I really want to own treasuries? I mean,
my take is yes. I mean, again, when we got up near 100 a month or so ago, I thought it was time to sell. So I recommended subscribers selling at 99.93 and 99.69. All right. And I'd recommended buying TLT when it was down around 91.13. So my take here is we're completing a correction from that 101.64 high. We've had 1, 2, 3. In Monday's weekly technical review, I said, okay, I think we're going to get a bounce to 95, 95.40, got to 95.62. I think the odds favor that we'll see TLT drop below 92.98 which means we'll see Treasury yields have another move to the upside. But I think there's a good chance, Blake, that this will mark a high in Treasury yields and a low in TLT. If TLT does, in fact, get below 92, 98, the RSI is likely to diverge. In other words, it'll make a higher low. The same thing happened last October. So again, what will make me wrong is we don't see any meaningful slowdown whatsoever in the economy, and inflation starts to not just be sticky, but starts to edge higher in the first half of next year. And all of a sudden, people are saying, we're not going to get any more rate cuts. We might actually get a rate increase. That would be problematic. Again, I'm still in the camp that I think once the election's over, government spending next year is not going to be as robust as it was this year. And that's going to be an important prop that is lessened in terms of supporting economic growth. And I think the economy is going to slow. And when it does, I think TLT and Treasury yields are going to come down fairly significantly. Now, if I'm right and we get this rally up to 105, 109 in TLT, because the economy, in fact, does slow, ultimately, I think we're going to see Treasury yields move up because of what you showed before about the deficit. I mean, if we're running a 1.9 plus trillion dollar deficit with GDP growth hovering around 3%, what's going to happen if we ever have a recession again? It'll be 3 trillion, 3.5 trillion. And I do think at some point in time, the lack of discipline in Washington regarding spending and the deficits, coupled with that amount of supply, I think ultimately the 10-year will go to 7.5%. So first, I think it can drop below 3.5%. And then I think over the next few years, we'll see it to 7.5%. That will be very devastating for the economy. I mean, we've already seen what's happened with interest expense. It's over $1 trillion a year.
Yeah.
We're spending more on interest than on defense. So again, I think there's ramifications coming. But if I'm right about a slowdown, mutual funds, insurance companies will buy Treasury bonds. And I think that's why we see a dip next year in Treasury yields. But ultimately, the lack of fiscal discipline is going to, I think, cause Treasury yields to go up because, as you pointed out, supply at some point in time matters, All
right. Well, let's talk about equities because here we are at all-time highs, oblivious to anything else that you're talking about, Jim.
I mean, again, the economy,
everybody's on the Trump bandwagon, right?
Well, I guess people think, yes, I guess that may be part of it. Some of the polls are showing that. People think of that as going to be a positive. Again, I think as we've been getting data that shows the economy is okay, people are looking at that and giving that more weight than, okay, the Fed may only cut, 25 basis points at the next two meetings instead of 75, which is what we thought. I think the economy is more important than just about anything else. So I think that's been the underpinning. I still think we're close to a 5 to 7% correction, but near term, just look at the moving averages on the S&P. 5,800 was the last little dip we saw. So again, you need to see some weakness show up. I didn't have it in here, but I'd be looking at the Russell 2000. Yeah. It hit a high around 2,300 sometime in the last year. And
I'll pull it up.
It got up to, I think, 2280 something. And to me, if the Russell takes out 2,300, then that's another positive in terms of, hey, after any pullback, we're going to see the market run even more. So that's one of the things I continue to look at. The semiconductor index has not made a new high as the S&P has made a new high. So, yeah, you can see how close we got, but there was a high at 23. Was that right there, that spike in July?
Yeah, 2305.
Yeah, so to me, that's kind of an important chart area for the Russell 2000. And if it breaks above that, there's no other way to look at that except being bullish.
Yeah.
But the rally from the low is so choppy, and it looks like a retracement rally just looking at the way it zigzagged its way up to the high we saw this week. But
And this
I'm
is
trying to
the
keep I'm
semiconductor
trying to
index
keep
that
an
you were
open
just
mind.
this is the semiconductor index you were just referencing, Jim. And
Yeah,
it is
you can
struggling
see.
for now.
Yeah, I mean, obviously that level around 200 or whatever where those two lows are, that's hugely significant. If sometime next year or in the next 12 months that gets taken out, people are going to be talking about, look at the head and shoulders on the semiconductor index.
Yeah.
But my point is just in the near term, this sector had been the leader for a long time. Um, it obviously from that low we saw in August, that looks like a very corrective rebound. NVIDIA did make a new high by, I think, about 20 cents, Blake. So it may be in the process of completing something itself. And the rest of the semiconductor index obviously has got challenges, as we saw with ASML, their earnings, Intel's got issues. In other
Yeah.
words, the non-AI sector of chips is struggling. And that's what I think is being reflected in the semiconductor index. So there are some things, again, that I think are setting up for a correction. But until we see, obviously, price start to roll over, you got to respect the upside because, hey, the trend is our friend.
There you go, Jim. It sure is. All right, Jim. Well, thank you so
What
much
a
for
what a
spending.
novel idea, right?
Right.
We've heard that before.
Thanks for spending your Friday with us. We appreciate it.
Yep.
And I know a lot of people are watching this over the weekend with their morning cup of Joe and enjoying it as well. So if you are, make sure you give Jim a big thumbs up. And Jim, what's the best way for traders to follow your work?
Macrotides.com, Jim Welsh Macro at Gmail. And I do appreciate the comments, even, especially when somebody says, I think you're wrong, Jim. I try to keep an open mind. I think in this business, one has to keep an open mind.
Oh,
It's that
yeah.
simple.
And to think you're always going to be right is silly. I mean, as a trader, I'm just lucky if I'm right half the time. It's just managing risk. That's what our jobs are. So,
You're 100% right, Blake.
so
Spot on.
Jim, I want to
All
say
right.
thank
Have a
you.
good weekend.
You do the same, and we'll look forward to catching up with you next week.
You got it, buddy. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.